Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, May 4, 2018. We are looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was a pretty interesting day out there across the markets today. So we have some lines on the chart. They're newly found lines. We're going to actually make some adjustments today based on the activity from today. And there's a lot to be learned from today's action, today's price action. So we're going to take some lessons away from what happened today, what we could have done, what some of us did do. I did get some emails from students today who did recognize what was going on and took advantage of the situation. A slight intermission. Thank you once again for all the comments underneath the videos. They're wonderful. Keep them coming. Let's keep the interaction going. I like the questions. I like the different perspectives. Let's keep it going. I also like the fact that you are liking the videos. It helps me out a lot. Share the videos with those that you think can benefit from this information. I'm paying it forward. If you pay it forward a little bit along with me, we all come out winners in the end. So what happened today? So today we had the non-farm payroll report come out at 8:30 in the morning. Now the futures were down ahead of that news that was at 8:30. So whether the excuse was the market was down because of the non-farm payrolls or some other reason, maybe it was down because of some renewed fears of the trade war with China, maybe it was down because of some other geopolitical event, Iran. It doesn't really matter what the reason was that the market was down. The fact was the market was doing something pretty specific that we talk about in here quite frequently, and it's also something that's definitely discussed in detail in the course at lazyeMinitrader.com. And it's something that happens and works on all time frames. It works on daily charts. It works on 10-minute intraday charts. It works on hourly charts, weekly. It doesn't make any difference. It works on all charts, all vehicles, all stocks, commodities, Forex market. It doesn't make any difference. These strategies work because all charts act and react the same way. Now, I'm going to get to exactly what happened in a second, but first, let's make some adjustments and let's actually take notice of a few things. And I'll give away part of a hint right here, which is you can see where the low of the day today was. The low of the day was right around where the 200 period moving average was. In fact, the low of the day was 261.15. I believe that's the right number. We're going to double check. I'll move this over. Low of day, 261.15 on the Spider. The 200 period moving average came in slightly above that, 261.29. So we spiked through it by just a few pennies and then reversed off that level for the remainder of the day. For the most part, the market was in a trend day up. Now, where did we go to? Well, quite interestingly enough, we went right to the downsloping trend line. This is the secondary downsloping trend line that we identified after the market began to formulate this trend line. Remember, it's not us making the trend line. It's the market that draws in the trend line. So once this pivot was put in on the 30th of April, that was enough where the market actually drew a potential trend line that the market would, under normal conditions, want to respect. And what happened today? On a reversal day, and we can all agree that the market definitely reversed today, and it was a pretty powerful up move, especially on a light volume Friday. I like to call them Friday floats. And while today was definitely a float higher for the most of, or the majority of the day, it was a trend day up, and rising tide lift all boats. But back to the trend line. So it is interesting that even with everything that was going on, the powerful reversal that we had off of the lows from this morning, and it was a wide range from low to high today. So keep in mind that there was about a 65-point range in the S&P 500, give or take, from low to high today. So that's a wide-ranging day. Remember, large swings in both directions when a market from the longer-term perspective is in a corrective mode, if you will. But the market got stopped by the trend line that the market identified for itself, and you can see that's where it spiked through it by just a little bit, but yet we settled right underneath that trend line by the end of the day today. Quite interesting how the market respected its own trend line that it just really identified for itself just a few days ago. Now I'm going to show you why we don't need these lines any longer. We're going to actually narrow down what our line in the sand is on the downside and where we can get some acceleration on the upside. Now before, we kept talking about last Wednesday's low, very important, and it was very important, and you can see how the market respected that pivot low by, on Thursday, yesterday, spiking down below the 200 period moving average, below last Wednesday's low, reversing itself, finishing in a pretty good fashion by the end of the day above the 200, put in what I like to call a pseudo doji candle. These are preferred at different places on charts. However, they do have meaning. It's just a matter of how much weight we put to that meaning based on where they come about on the charts. But yet again, it was a pseudo doji candle, a tail candle. That is a signal of a reversal, also part and parcel to a lot of the information on trend change signals discussed in the course at Lazy E-mini Trader. And then what happened? Today, what we did was not a full retracement, but a partial retracement of yesterday's tail candle. We took off to the upside. Where was the trade? Well, we discussed retracements. We discussed them on various charts from time to time. We discussed tail candles. Retracements of a tail candle is an opportunity for a trade which is close to risk. We talk about that quite frequently, staying close to risk, getting in a trade close to where you know that you're wrong in the decision or the actual trade itself. So here's the bottom of yesterday's low, the bottom of the tail candle. So if we were to get a close below yesterday's low, then the trade is wrong if we're taking a trade to the long side. What I'm saying is, I'm suggesting that we buy the market on a retracement of a tail candle. Now, ideally, we like to see about a 50% retracement. This one didn't quite fit the bill, but it did have the 200 period moving average there. So there was reason why we really didn't get a full 50% retracement. And by the way, as I discussed this after the fact, I'm fully aware and completely empathetic to the fact that this is not an easy trade. In real time, it's not easy to take this trade. I get that. You have to be able to identify it. You have to be able to have conviction that a high percentage of the time these trades work. And when they do fail, although they do create a loss scenario, a loss of capital, it's close to risk. Let me explain. So where is the bottom of yesterday's tail candle? Yesterday's low is at 259.05. So this is a daily chart. So therefore, this is considered a daily trade. Now, when taking a daily trade, we're not looking at the intraday chart because we don't really care about the ups and downs by a certain amount, by a minimal amount, a nominal amount during the trading day. If we're taking a trade off a setup on a daily chart, we're concerned with the day-to-day moves. We're concerned with the multi-day opportunity that exists in the trade. So if a trader was able to get into the trade at, let's just say, for argument's sake, 262. And 262 isn't the low of the day by any means, so it's a fair number to give this hypothetical example. So if yesterday's low was around 259, and we're going to stop out, getting in at 262, stop out with a $3 stop, or somewhere in the neighborhood of a $3 stop. Maybe it's slightly more because you didn't get out right underneath yesterday's low. But the point is, it's around 1%. It's a 1% risk to an interestingly nice potential reward if it works out in your favor, right? So let's just say that we went up for 2 or 3 days off this tail. Let's say today wasn't the only day that we're going to have an up market out of this run. Let's say it goes into the 50 period moving average. Let's say it goes into the 100. Let's say it goes all the way to what we said was maybe improbable, but certainly possible last night, even all the way up here. Now it doesn't seem so far out of the question that we get up to that top end of the trend line, or that top trend line that we've been talking about, completing what? The ABC pattern. We talked about it last night. A, so the B gets moved over to here, and here's the final leg, which is the C leg up, still thinking that whenever we meet this trend line, that provides a decent level of resistance to the market. But this is still playing out what the roadmap that I laid out suggested several days ago. Long before we even made last Wednesday's low, that's the point in which we started mapping out this potential roadmap before this low even took place. So we're still hanging in there on the original concept. Get back to the trade. Let's just bring it down to a $30 stock or a $25 stock. It's 1/10 the price. So a $3 stop on a $266 or $262 trade, or SPY is $262 at the time, okay? Bring that down to a tenth, bring it down to a $26 stock. That's a 30-cent stop. Would you have a 30-cent stop on a daily chart of a $26 stock? Absolutely. That's a tremendous risk reward. You have to train yourself to know what you're looking for. The charts are always trying to tell us something. The idea is, are we able to translate or decipher what the chart is telling us is going to happen next? Sometimes yes, sometimes no. But the more puzzle pieces that we can put on the table, giving us more clues, more evidence of what's going to happen, the higher the probabilities are that we're going to be right. So here are the lines in the sand. So the first line in the sand on the downside is going to be today's low. Today's low happens to come in at 261.15. We're going to put a line at 261.15. That's our line in the sand. If we should close on a daily close below that level, 261.15, that's a negative. That's going to mean lower prices are coming. Today's low is a line in the sand. Forget about, even though it's close to, but forget about last Wednesday's low. Today's low is the new important low in my book. On the flip side, on the upside, where can we get some acceleration to the upside? A close above 267.98. That's going to be an important close. Not going to be easy for the market to close above that level. But if the market were to close on the daily chart above 267.98, I think we have another leg higher, and that puts us right here or even slightly above this downsloping trend line that we've been talking about for quite some time. Before we move on, I thought I would just bring up a chart of the S&P 500 Emini futures contract. And you can see here that this is the same daily chart. Here's Thursday's tail candle, and here's this this is Friday's activity, all the way down to almost a 50% retracement in the tail. Not quite, but spiking through just by a little bit, the 200-period moving average. This is the futures chart, but essentially it's the same thing as the spider chart, the S&P 500 cash index chart. They all look the same, but you can see here the retracement. And off the daily chart, again, whatever the reason that the market was being pushed down earlier in the day to complete that retracement, that was what was going on. It was the excuse of whatever news event it may or may not have been that the media reports. But the reality is the market was simply doing a retracement of yesterday's tail candle, preparing for another move higher. The IWM, my favorite market-leading indicator on the up and the downside. So the IWM had a nice healthy update today, up 1.25%. Now, it did not outpace the spider on the upside today. The spider was up 1.42%. So that's interesting on a day when everything was up across the board and the markets were in a trend day up for the majority of the day. The IWM was not leading the charge in the upward direction. That has me a little suspect of the IWM right now. I'm just putting it on the table. It's a piece to the puzzle. I'm not sure exactly how much weight it's going to get right now, but I'm aware of it. And it also supports the case, and this is just another puzzle piece, of volume. So the IWM came in today with less than the average 90-day volume. Average 90-day volume, a little more than 22 million shares. Today, less than 18 million shares in the IWM ETF. The SPDR today, 91 million shares traded, less than the average 90-day volume. What that tells us is that we did not get huge volume on the reversal to the upside. If we did, that would mean institutional participation. That would mean much higher prices likely coming. The fact that it was not tremendous volume, it was less than average volume, even on the reversal today, still tells me that we're not out of the woods just yet, and this market is probably doing, and I say probably knowing full well the market can do a lot of different things, but it looks to be trying to trace out the roadmap that we identified almost 2 weeks ago. Look where the IWM finished the day. Inside of this upsloping trend line that comes over from where, yes, the monthly chart, the long-term chart, way back from 2011, we still find that this line is important. Any way you look at it, almost any time you look at this chart, we can find an area where this trend line is important to this chart. So anyway, the IWM was up today. Not going to take away from a nice healthy up day, up almost $2 in the ETF, the IWM. But keep in mind, when we look at the weekly chart, okay, we're still not out of the woods, and it looks very similar to a lot of the other charts out there. Until and unless we can close above this level, this is still a bearish pattern. This is a bearish wedge pattern that will generally play out with another leg to the downside. So we always have to keep the bigger picture in mind. Even if we go up for a few more days in both these, in any of these indexes, it doesn't matter. That doesn't take away the point that if we don't close above that level that I just pointed out on the weekly chart, then all bets are off, and there's still likely another leg lower. So when you go over to the weekly chart, just before we go on, of the SPDR, you'll see here it's the same routine. We have this downsloping trend line that will likely stop the market, find a resistance point to the market. But look what else we have. I mean, look where this high comes in here. Now, we're already in a position where even if we got up there, this week or next week, we're already kind of lower than the high of this red breakdown candle. So either way, you can see where the resistance really lies. If we have to move higher, there's a lot of resistance up above in the S&P 500. So it's just something to note. Again, this is one of those puzzle pieces that we kind of put off to the side a little bit, always having to keep the big picture in mind. So let's move it along because I have something really slick to show you next. So look at the VIX. So quite interesting, and I didn't see this happen when it happened, and I don't even know that it would have given anybody enough time to buy the VIX down here when it spiked down to, and I don't know whether any kind of trades went off in the options market during this period. I'm not exactly sure. When you look even down to a 5-minute chart, you can see it was a quick, just a thrust lower and then a spike right back up. And when you look at the 1-minute chart, I think it shows something similar. I'm pretty sure I looked at this before. I don't want to take up too much time trying to scroll around on a 1-minute chart. But, well, there it is. I found it. It was at 8:35 in the morning, in that neighborhood, 8:34 in the morning. Well, here. It was 8:31, pardon me. So it was 8:31 in the morning. Something happened with the VIX. I find that interesting. I'm not sure exactly what to make of it just yet, but think about it for a second. We've been talking about the fact that the VIX was putting in a bearish pattern. And the bearish pattern would likely mean lower prices for the VIX, higher prices for the stock market. We discussed that at least for the last 2 or 3 days in a row. We did spike up yesterday when the market sold off, but we fell right back down and we finished pretty much where we opened the day, below the 100 period moving average. And then we had these shenanigans that took place today early in the morning. But you can see here that the pressure is certainly to the downside in the VIX, and that would likely mean higher prices for stocks. So I think it's interesting to point that out and draw the comparison, certainly because we've been talking about it for the last several nights in a row. Now, the point of this 1150 line was I kept saying that anytime the VIX gets down in that neck of the woods, 12, 1175, 1150, down in that area is a buying opportunity for the VIX. Now, what happened today isn't necessarily conducive to what we call a buying opportunity. I don't know anybody that could have executed a transaction in that what seemed to be almost like a flash crash. But is that somewhat of a smoke signal of something coming? Is that maybe foretelling of where price is headed next? We'll see. We'll keep an eye on it. Just wanted to point it out. Here are the transports. And in the transports, again, we had a nice up day today, up over 1%. Not an overwhelming up day. We came into the 20-period moving average and backed off from it pretty good. So we're sandwiched in between these moving averages up top and the 200 below. Yesterday having spiked it a little bit. We're not out of the woods here yet. When you look, today was a nice up day, but when you look at the weekly chart, nothing's changed. We're still below the 20-week moving average. As long as we maintain, the longer we maintain, and as long as we maintain in this formation, in this pattern, this will likely mean another leg to the downside. However, if we do get above the 20-week moving average, and we do get above a couple of other important levels in the transports, that'll turn the tide to the upward direction. But right now, it is what it is. And yes, we had a nice up day, but nothing's changed from the longer term perspective. The financials, you would expect the financials to be participating on a day like today, and they did. So the XBD was up less than 1%, so it wasn't a tremendous day for the financials. Sandwiched in between the convergence of the 50 and the 20-period moving average and the 100-period moving average. Again, it's an up day, but when you look at the bigger picture and you look from a longer-term perspective at the weekly chart, you see here that, again, it was just another week inside of a bearish wedge pattern that we're just hovering above this 20-week moving average. And the longer we trail above this 20-week moving average, the more susceptible it is to not be supportive of the market. The more susceptible the market would be to break through that 20-week moving average. When you look at the XLF, had a better day than the XBD did, up 1.3%. The XBD was up about 0.8 or 0.8%. But here's the weekly chart, so you can see here, same routine. I don't need to rehash that. When you look at the daily chart, it was a nice up day. It was a reversal day. It was a full retracement of yesterday's tail candle in the financials, and we had a nice reversal day. This could be good for, 2, 3, 4, 5 days. Absolutely. Nothing says that they can't try and get this market back up to the top end of this channel or top end of this range up near the 100-period moving average. Here's the top end. Here's the bottom end. We just tested the bottom end. We didn't want to break the bottom end. So here we are back inside the channel, and we're headed toward the upper portion of the channel. And that's just the way markets work. They go back and forth until such time as they're ready to break either down from a channel like this or up from a channel like this. Either way, it will stay in the channel until it's ready to go in one direction or the other. Gold, not much doing in gold. It was up a fraction today, but the reality is we're at the bottom portion of this channel. The weekly close was good. The weekly close was inside of the 1309 spot 50 number. That was very important to find out where we closed the week. When you look at the weekly chart, you see that we spiked down beneath this pivot low, beneath this channel. However, we closed back above that pivot low. That tells you a couple of things. That tells you, number one, that number, that pivot low, the 1309 spot 50, that's important. Well, whether it's important by 50 cents on the upside or 50 cents on the downside, we'll let the market decide. But we have to have a point of reference, and that pivot low we've been using as a point of reference, and we know that the market was not able to close below that level for more than 2 days. It popped right back above that level, making the week close inside of that important number. So we'll take the weekly close as more important than the 2 daily closes below that level, and we'll say that the market survived inside of an important pivot low another week. So we'll see what happens next week. We'll move on. And the band plays on. Crude oil continues to have its all-out assault on the upside. So we had another day today where we're up 2%. That's what's happening here. You see that we're essentially in an uptrend, and crude oil is essentially just melting up. And that's what's going on. And we're going to melt up until we get, and I made a couple of revisions. Let me go to the weekly chart and I'll show you what we're looking at. So we're going to call this the hot zone. And this is where we're headed. So we're headed somewhere in the neighborhood of between 74 and 78. Now you're going to say, well, that's a wide range. That's a $4 range. How are we supposed to pick a number inside that range and short crude oil when it gets there? We're not. We're going to wait for a signal of a trend change. I'm giving you the area that we have to begin watching for that signal. Maybe it happens around 74. Maybe it happens around 78 or anywhere in between. What I think is going to happen is we're going to get up there, number one. And 75 is just too much of a juicy number for the market not to hit. The more I thought about that, the more I figured, that's a really important number just from a numerology perspective. So we'll use that as just a round number and say we're going to get up to around 75. Once it does, we're going to be focused mainly on the daily chart at that time, and we're going to be looking, and the intraday chart. I will be looking intraday for a signal of a reversal, of a trend change. And I want to see something happen on volume. It will likely happen with the culmination of an event. It'll happen with the culmination of a news event, a geopolitical event, something having impact in the crude oil complex. Maybe it has to do with Saudi Aramco that's coming public. Maybe it has to do with some other geopolitical event. Maybe it has to do with Iran, which is obviously pinned as one of the reasons why the oil market is running up because of fears of whatever. Doesn't matter. We've been talking about this number for a very long time. Whatever the reason or the excuse becomes, let it happen. It makes no difference what the reason becomes for the run up to 75. All we want to be concerned with, if you're not long, I'm waiting, and I'm not long crude oil right now, so I'm waiting for it to get up to this area, and that's where I'll be looking for an opportunity to find out where it's going to make a trend change and be able to have a reasonable, close to risk opportunity for a whopper on the downside, probably come off from that level $10 relatively quickly. When crude changes trend, it can change trend quickly. Before we go tonight, I thought we would take a look at a couple of the leading stocks in the news, stocks that are widely held by a lot of mutual funds, pension funds, hedge funds, individuals. It gives a good barometer of, what's really going on under the hood when you look at some of the biggest names that are the widest held. You want to make sure that they're not, something quirky isn't going on. So Tesla's been in the news a lot. Elon Musk has been in the news a lot. They have to raise money. So is this chart a bullish chart? Is this chart a bearish chart? It's a good question. So I believe, if I'm reading the news correctly, that he's not necessarily sold on the fact that they need to raise money. I know from just poking around that the bond market is not going to easily lend them money. They would have to be junk bonds, and the cost of money is too expensive. They couldn't sustain the repayments on that debt, and it would just be a bad spiral, and that's how companies get in trouble. So they would have to raise equity. I think I talked about this once before. It doesn't really matter. Whatever they have to or don't have to do, it's not going to really make any difference. The charts are actually telling us what's going on, and this is what, at least my interpretation of what this chart is telling us. What I see happening is, I see an up move, and I see a bullish pattern. I see a bullish wedge pattern, a bull flag pattern that's developing on the daily chart. This will normally result in another move to the upside. So I want to confirm what I'm seeing. And what I'm doing right now is just kind of letting you inside my brain on the thought process. When I look at a stock, what am I looking at? What do I look at first? What am I thinking about? What causes me to look at something else? That's what I'm doing with you. That's what this exercise is. So I look at the daily chart and I say, well, this is pretty clear. It's a bullish pattern, and it really, unfortunately, it's hard to hop on this pattern because it's bullish until and unless you close below that low here on the daily chart. So you have a lot of white space down here in between where price is now and where this actually still stays bullish. So you're not close to risk. So that's not a trade I would be willing to take for the long side of Tesla, right? For a long-term trade. I don't want to take the heat if it goes down to 260 knowing that there's technically nothing wrong with the chart. That's not something I'm willing to do. So let's go over to the weekly chart and see what we have here. So we have an interesting picture. We have a nice, weekly test of the 200-week moving average twice. We have a nice reversal, although it's not a full reversal. We never did get above the high of that breakdown candle, but it certainly was a powerful week. And what we're also doing is you're seeing on the weekly chart the same bullish pattern that we just looked at on the daily chart. That's the same pattern. So the weekly chart is confirming, obviously, what we just saw on the daily chart, but we know that we have this high here to contend with. But if we consolidate for long enough and we build up enough energy, it will have built up enough energy to blast through on the upside and have higher prices over and above this, breakdown candle high. Let's go over one more notch to the monthly chart and see what we have. And this is what I see. The first thing I see is a stock that really went, you can call it parabolic, you can call it whatever you want. It probably got to a place it didn't belong. If you just want to, think in terms of, even though I like to, only look at the technicals, I'm aware that valuations do matter to an extent. A company can't be valued at a ridiculous number and sustain that number, and the charts will tell you that it's unsustainable. That's the way it works. So we saw a reversal in a monthly reversal candle back here. This candle right here that the black line runs through is a reversal candle. That was a monthly reversal. That was telling us that lower prices are coming. Now, we also have a pretty big, large, another candle, another breakdown candle on the monthly chart. And what this will normally tell you is that it's like a reversal candle. It's telling you, normally, that lower prices are coming yet. But what happens is we like to retest former breakout and former breakdown areas. So not to say that we can get all the way back up to around 350 up here, but the market will want to try, and it will use all kinds of excuses and news events to try and work its way up to that area. Maybe it gets to 320. Maybe it gets to 330. I don't know. But it could take its time for another couple, 3-4 months to run up to that level and then also fail one more time. So while it may look bullish on the daily and bullish on the weekly, I think very long term, this is ugly for Tesla until and unless we can get above the high of this big breakdown candle on a monthly closing basis. That's the only way out of that chart pattern that we just identified. Here's a chart of Amazon, and Tesla took longer than I thought it would. So I was going to run through a bunch, but we're going to cut it short. I'm just going to do a couple more. So Amazon, you can make two cases with Amazon. I don't like to see this type of chart formation. It gives me a little bit of a headache, and let me explain why. I can make two cases. I can make a case that here's a down move from a high where we reversed after earnings. We got above the old highs, and we reversed, and we closed below those highs. That's a negative. Now making a bearish pattern, that's a negative. This is a bear flag pattern. That'll normally result in another move down. You have a gap here, very conveniently, could come back to fill that gap right around the convergence of these moving averages. Can easily see that taking place. Everything I just described to you has played out on many, many charts in the past. I've seen it over and over and over again. But here's the problem. Here's where it doesn't play out. Here's where it fails. Because I can also make a case that here's an up move into earnings, okay? So we had the day before earnings into the day of earnings. So we have that big move higher, okay? And now we have a bullish consolidation pattern after that big push higher, building energy in a bull flag pattern for another move higher, even though it looks like a bearish pattern, because I can easily make the case for that bearish pattern. I can make both cases, and I've seen both work out. And that's why when I see this chart set up, it's not a high probability for me one way or the other. I would say there's technically nothing wrong with this chart. It's in an uptrend, and that's the way I'm going to have to leave it. Going over to Facebook, this is a bullish consolidation pattern. Facebook is telling us that higher prices are coming. Big up move, consolidation, bull flag pattern, maybe needs some more time, maybe we bust out of this, but this is telling us that Facebook wants to fill this gap up here around 185. That's what this chart activity is saying right here. That's what I get just looking at the daily chart. If I flip to a weekly chart, what do I see? No accident, no coincidence. Look where we finished. The high of this breakdown candle is 177.17. The high of this week was above that, but we closed below 177.17. That's not an accident. It's not a coincidence. It's what happens. It's how markets trade. All charts act and react the same way. You can find that on weekly charts, on 10-minute charts, 5-minute charts, hourly charts, daily. Doesn't make any difference. All charts act and react the same way. This happens over and over again. Now, this isn't to say that we can't close above there next week and go fill that gap, or we can't go up and fill the gap and close below there next week. Both those scenarios are possible. What I'm saying is, it's not an accident or a coincidence that we didn't close above that high today. They had every opportunity to close Facebook a few pennies higher above this weekly high from the week ending 3/23 of 2018. They could have done it if they wanted to. They chose not to. You go figure that one out. So here's Netflix. Daily chart. Same story. Look where we closed. What was the high of this breakdown candle? 320.25. Where did we close today? 320.09. Every opportunity to close above that level if they wanted to. That would have turned Netflix. It's not bearish per se because we're above all the moving averages on the daily chart. That's not bearish by any means. But we do have a down move and we have bearish consolidation. And until and unless we can get above that high on a closing basis on the daily chart, then that bearish pattern is still active. And that's all I'm saying. It could be unactive or deactivated on Monday. That's fine. I'm just stating what we're looking at right here, right now. We'll look at one more. We'll look at Google. And so Google is a very similar story. You see we're just going back and forth through these moving averages. And until and unless we can get above on a closing basis right here, and that would also require a close above, most likely by the time we got there, the 50 period or 50-day moving average. That's the blue trend line. Until and unless we can close up there and begin to fill this gap, then, it's a bearish pattern. But if we can close above here, then we can turn slightly less bearish. And if we can get above both these moving averages, then the trend will turn upward and we can see higher prices in Google. And that's a quick and dirty analysis on Google. With that, folks, it's everything I wanted to and intended to discuss tonight, so I will give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.